One of the top milestones for dividend-paying stocks is the achievement of becoming a Dividend Aristocrat. Dividend Aristocrats are stocks that have met 3 different criteria. 1, they have to be a member of the S&P 500. 2, they've increased dividends every year for at least 25 consecutive years. And 3, they have to meet certain market cap and liquidity requirements. And while the S&P 500 has outperformed the Dividend Aristocrats lately due to the tech stock run-up, the Dividend Aristocrat Index has actually outperformed the S&P 500 since 1989. There is even a dedicated ETF called the ProShares S&P 500 Dividend Aristocrats ETF, which tracks all 66 Dividend Aristocrat stocks. And as we can see, the majority of Dividend Aristocrat stocks are consumer staples, industrials, materials, financials, and healthcare stocks. So in this video, we're going to be reviewing every single Dividend Aristocrat stock in 2025. I put together an entire spreadsheet with details on each of these stocks, and you can get it for free at the link in the description. To analyze these stocks, we'll be using Seeking Alpha and Ticker Data. Link in the description to both of those as well. Now let's dive in. Coming in at number 1 with 69 years of consecutive dividend increases, we have Dover Corporation operating in the industrial sector, and over the past decade, they've increased their dividend payouts by a total of about 40%. And if we look at the stock over the past year, it's actually done pretty well, currently up close to about 29%. So if we jump over to my dividend breakdown sheet and come up here and plug in DOV, and again, all this data will automatically load in thanks to the help of the Ticker Data add-on in Google Sheets. At tickerdata.com with the link in the description, you can auto-import stock financials straight into your spreadsheet and also get access to any of my spreadsheets. But we can see for DOV, starting dividend yield sitting at about 1%, but here's what we'll notice. Over the past few years, dividend growth has really slowed down. 5-year dividend CAGR of only about 1%, and you have to keep in mind, anytime the dividend growth rate is below the rate of inflation, that company is technically paying out less in dividends every single year. Now, here's the good news. They have the ability to increase their dividends by a higher amount if they choose to do so, because free cash flow has grown considerably over the past 5 years. In 2018, free cash flow was sitting at $618 million, while in 2023, it finished at $1.1 billion. So we can see a free cash flow payout ratio of just about 24.86%, leaving plenty of room left over to reinvest back into the business and grow that dividend if they choose to do so. Coming in at number 2, we have another stock in the industrial sector, and that is Emerson Electric Company with 68 consecutive years of dividend increases, and over the past decade, we can see they've increased their dividend by a total of close to 27%. And if we look at Seeking Alpha, the stock is up over 36% in the last year. And if we jump over to my dividend breakdown sheet, we can see a low starting dividend yield currently sitting at about 1.62%, and the dividend growth over the past decade has been very, very slow. 10-year dividend CAGR of just 1%, and a 5-year dividend CAGR of just around 1% as well. And we can see the reason why the dividend is growing so slow. It's because free cash flow is not growing. Again, if you want dividend growth to be high over a long period of time, you need your free cash flow to continue to grow, and that has not been the case for this stock. But the good news is the free cash flow payout ratio is only sitting at about 41%, so the dividend does look healthy and sustainable. At number 3, we have the consumer defensive stock, Procter Gamble Company, with 68 consecutive years of dividend increases, and over the past decade, they've increased their dividend by a total of 63.2%. And if we look at Procter Gamble over the past year, they're currently up about 11%, and we're at one point trading as low as $153 per share. Now, if we look at them from a dividend breakdown perspective, the starting dividend yield sitting close to 2.4%, and the 10-year dividend CAGR is sitting at 4.3%, and the 5-year at about 5.24%. But we can see this is a relatively slow grower, 10-year free cash flow CAGR of just 5%. In the 5-year free cash flow CAGR of just about 6 to 7%, and they use about half of their free cash flow to currently pay out dividends. Coming in at number 4, we have Cincinnati Financial Corporation with 64 consecutive years of dividend increases, and over the past decade, they've actually increased their dividend by a pretty high amount, over 80% total. And if we look at them over the past year, they're up over 25%. And if we look at the dividend breakdown for this, we can see they have a starting dividend yield sitting at about 2.31%. A low free cash flow payout ratio, and dividend growth has been about 6% over the past decade and close to 7 to 8% over the past 5 years. And they've actually grown free cash flow at a pretty healthy rate as well at about 12%. And then coming in at number 5, we have a stock that's actually on here by technicality, and that is Kenvue, the consumer defensive stock. And it's on here because it was a spinoff from Johnson & Johnson. But with that being said, they technically have about 62 years of annual dividend increases. So if we look at them on Seeking Alpha, they've been very flat over the past year, only up about 2%. And if we look at them from a dividend perspective, keep in mind, they're not going to have a lot of historical data because, again, they were a recent spinoff from Johnson & Johnson. But as of right now, they have a starting dividend yield of about 3.78%. Coming in at number 6, we have Johnson & Johnson, the healthcare stock, with 62 annual years of dividend increases. And over the past decade, they've increased their dividend by about 80%. And if we look at the past year for Johnson & Johnson, it's had quite a bit of a sell-off over the past few months, down about 5%. But if we look at the starting dividend yield, this is the highest yielder we've seen so far, coming in at about 3.24%. And we can see the 10-year dividend CAGR at about 5.23 and the 5-year dividend CAGR at 4.29%. So pretty decent history of growing those dividend payments, decent dividend growth, and a nice starting dividend yield at about 3.24% with a 33% payout ratio. At number 7, we have Colgate, stock ticker CL, the consumer defensive stock with 61 years of consecutive dividend increases and the total dividend growth over the past decade coming in at 42%. And if we look at this company over the past year, it's up about 8.5%, and the starting dividend yield is sitting right at 2.2%, and the 10-year and 5-year dividend CAGR is both on the lower end at about 3 to 3.5%, and obviously you're going to see low levels of dividend growth because free cash flow has not been growing at a high rate either. So dividend growth will continue to be slow unless free cash flow starts to grow. But as of right now, free cash flow payout ratio is only sitting about 57.5%, so the dividend is safe. Next on the list, we have our first utility company, and that is NextEra Energy with 61 consecutive years of dividend increases. And look how much they've increased the dividend over the past decade, almost 184% total. Now, if we look at the stock over the past year, it's up about 17.9%, and if we look at the dividend breakdown, starting dividend yield is close to 3%, with a 10-year dividend CAGR of 11% and a 5-year of 10.5%. So we're talking about a nice combination of a history of dividend growth, growing those dividend payments, and a nice starting dividend yield. But here's what concerns a lot of people: free cash flow payout ratio at 215%. Well, you have to understand when looking at a utility stock, typically you're going to pay more attention to the earnings payout ratio, which is sitting at 51.74%. So this company's been a good dividend grower. It's a great dividend aristocrat. At number 9, we have the industrial company Nordson Corporation with 61 consecutive years of dividend increases. And look at how much they've increased the dividend over the past decade, over 300%. And if we look at the stock over the past year though, it's actually down by about 13.5%. But if we look at the dividend breakdown, we can see a starting dividend yield sitting at about 1% with a 10-year dividend CAGR of 10.34% and a free cash flow payout ratio of just close to 24.78%, leaving plenty of room to continue to grow those dividends and a pretty good free cash flow growth rate over the past 10 and 5 years. Coming in at number 10, we have Hormel Foods Corporation, the consumer defensive stock with 59 consecutive years of dividend increases, and this is another stock that's really rapidly grown the amount it pays in dividends over the past decade. And if we look at the stock over the past year, it's traded pretty flat with some volatility early in February of 2024. But if we jump over to our dividend breakdown sheet, we can see the starting dividend yield pretty high, sitting at about 3.7%, and the 10-year dividend CAGR above 11%, and the 5-year sitting at about 6.25%. But free cash flow has stagnated quite a bit over the past 5 years, as we can see right here, leading to the free cash flow payout ratio over time going higher and higher. Next on our list, we have the Real Estate Investment Trust, Federal Realty Investment Trust with 57 consecutive years of dividend increases. This is the first REIT we've seen on the list. And if we jump over to Seeking Alpha, over the past year, they're up about 5.6%. And if we look at the dividend breakdown sheet, we can see the dividend growth has been slow, but that's pretty typical for a real estate investment trust, but the starting dividend yield is pretty high, sitting at about 4%. Now, when we look at the payout ratios, this looks pretty alarming at first glance, but we have to remember REITs are required by law to pay out 90% of their earnings in the form of dividends, so the payout ratio, or even the free cash flow payout ratio, really doesn't do a good job showing us how sustainable those dividends are. So instead, what we actually need to do is look at the dividend safety as it relates to adjusted funds from operations. So right here, we can see AFFO payout ratio for FRT is sitting about 86% to 88%, which is still relatively high, but is sustainable for REITs. Next on the list, we have Target Corporation, stock ticker TGT, with 57 consecutive years of dividend increases, and they've grown that dividend quite a bit over that time period. And if we look at them over the past year, they've traded pretty flat and saw a pretty large sell-off, it looks like in mid-November, going from 156 all the way down to 121. But if we look at the dividend metrics for this company, starting dividend yield is sitting at 3.13%, and the 5-year dividend CAGR 11.3%. So they've grown dividends pretty fast over the past 5 years, and you can see that charted out right here. That's rapid dividend growth. Now, the free cash flow CAGR over the past decade, somewhat slow, about 2.21%, and we can see free cash flows come down pretty significantly since 2020 and 2021, but overall the 5-year free cash flow CAGR sitting at 9.2%. Next up, we have Cisco Corporation with 54 consecutive years of dividend increases, and if we look at them over the past year, they're down by about 3.5%, and if we look at the starting dividend yield, sitting at 2.8%, with decent dividend growth coming in at about 5 to 6%, and free cash flow seems to be a little bit higher, closer to about 7%. Now we come to Grainger, the industrial company with 53 consecutive years of dividend increases, and they've more than doubled their dividend payouts over the past decade with a 10-year total dividend increase of 113%. So if we look at the stock over the past year, up about 25.8%, and if we look at the dividend breakdown, the starting dividend yield is very low, but they don't use a lot of their earnings and free cash flow to pay out dividends, and the 5-year dividend CAGR is decent at about 7%, but the 5-year free cash flow is even better, above 14%. That's really good free cash flow growth. So because of that, we can see the free cash flow payout ratio is trending downwards, meaning they're using less of their earnings and free cash flow to pay out dividends, which is a good sign. Now we come to the healthcare stock Becton, Dickinson and Company, stock ticker BDX, with 53 consecutive years of dividend increases, and over the past year, they're up by about 5% due to the recent run-up in their share price since the start of December. Now, if we look at them from a dividend perspective, starting dividend yield is sitting at 1.56%, and the 10 and 5-year dividend CAGRs both sitting a little bit above 5%, but free cash flow growth has been pretty slow over the past 5 years, and for a while, from 2013 to 2021, free cash flow growth was actually phenomenal, but we've seen a pullback in 2022 and 2023. So obviously, in order to keep growing dividends, we are going to need to see that free cash flow growth start to ramp up a little bit, but for the time being, the free cash flow payout ratio is only sitting at 52.6%, so the dividend is very healthy and sustainable for the time being. At number 16, we have PPG Industries, operating in the basic materials sector with 53 consecutive years of dividend increases, and they've gone down quite a bit over the past year, 13.64%. And if we look at the dividend metrics, we can see the starting dividend yield sitting at 2.16%, 5-year dividend CAGR of 6%, and a 10-year dividend CAGR of 7.3%. But free cash flow growth has been pretty good over the past 5 years. We can see 2018 to 2023, it's trending in the right direction, but we had a couple of low years here, especially in 2022, but overall a pretty good history of growing those dividend payments with a nice low free cash flow payout ratio of 32%. At 17, we have a stock that has been rapidly growing its dividend, and that's Abbott Laboratories, with 52 consecutive years of dividend increases, and over the past decade increased the dividend by 259%. And if we look at the past year, it's up about 13% after a big jump up in January. Now, if we look at the dividend metrics, starting dividend yield is sitting at 1.75%, but you can see the dividend growth is really ramped up for this stock, 5-year dividend CAGR of close to about 12%, but keep in mind they are using the majority of their free cash flow to pay out dividends, not leaving a lot of capital left over to reinvest back into the business. And now we come to Kimberly-Clark Corporation, stock ticker KMB, with 52 consecutive years of dividend increases, and this stock is up about 8% over the last year. And if we look at the dividend metrics, the starting dividend yield is pretty decent, sitting at 3.73%, but those payout ratios are starting to climb a little bit on the higher end. Now, dividend growth has slowed down a little bit over the past 5 years, but it wasn't necessarily very high in the first place over the past 10 at about 4%. And free cash flow growth is mid-single digits. We can see a 5-year free cash flow CAGR of about 5 to 6%. So this is by no means a high growth company, but it does have a nice starting dividend yield with a good dividend history. And then we come to one of the most popular dividend stocks of all time, the Coca-Cola Company, owned by Warren Buffett, with 52 consecutive years of dividend increases. And if we look at the stock over the past year, it's only up by about 5.56%. And if we look at the dividend metrics, what we can see is the starting dividend yield for this company is sitting at 3.08%, and they use the majority of their capital to pay out that dividend, which is pretty typical for a more mature company. And the 10-year dividend CAGR is coming in close to 5%, and a 5-year dividend CAGR closer to about 4%. And free cash flow has done a decent job of growing actually over the past 5 years, with a free cash flow CAGR of close to 10%. Next on the list is AbbVie, and this is a healthcare stock that's actually on here by default because it's a spinoff of Abbott Laboratories. But accounting for the spinoff, they have 52 consecutive years of dividend increases. And if we look at them over the past year, they're only up about 7%. But if we look at the dividend metrics, this is going to be one of the best stocks we look at in the entire video. Look at the starting dividend yield, sitting at 3.74%. And look at the 10-year dividend CAGR, nearly 15%. In the 5-year, almost 9%. And this is all backed by growing free cash flow. So we can see rapid dividend growth with an already high starting dividend yield, and the free cash flow payout ratio has remained in a very healthy range, below 50% for the majority of the past decade. This one is a great combination of starting dividend yield, dividend growth, and future potential growth in free cash flow. The next stock on our list is another popular one. We have PepsiCo, stock ticker PEP, in the consumer defensive sector with 52 consecutive years of dividend increases. And if we look at the stock in the past year, it's down about 10%, with most of the sell-off coming in just the last few months. And if we look at the dividend metrics, the starting dividend yield is one of the highest it's ever been for this company, sitting at about 3.52%. They've been growing that dividend at a rate of about 7% over the past 5 and 10 years. But here's the concern when it comes to Pepsi. Yes, that dividend is growing, but so has the free cash flow payout ratio, meaning they've been using more and more of their free cash flow to pay out dividends. So when that happens, eventually dividend growth doesn't become sustainable. So we're going to need to see more free cash flow growth in the coming years from Pepsi. Coming in at number 22, we have Nucor Corporation, stock ticker NUE, and this is a company that operates in the basic materials sector with 52 years of consecutive dividend increases. But if we look at the past year, the stock is down over 32%. Now, if we look at the dividend metrics, here's what we can see. The starting dividend yield is pretty low, sitting at about 1.7%, and the dividend growth really hasn't been that high either, as we can see. But I will point out they use very little of their capital to pay out dividends. And we can see the starting dividend yield is low, sitting at about 1.7%, and the dividend growth has not been anything too impressive over the last few years, but I will point out they use very little of their capital to actually pay out dividends, so they could increase it more if they choose to do so. Next up on the list, we have Walmart, consumer defensive with 51 consecutive years of dividend increases, and this stock has skyrocketed over the past year, up nearly 79%. And what we can see, yes, a history of dividend growth, but the dividend growth rate has not been very high. 5-year dividend CAGR of just 3.2% and a 10-year of about 2.6%. But to be fair, they are only using half of their free cash flow to pay out dividends, and they have a starting dividend yield of 0.84%. Now we come to S&P Global, stock ticker SPGI, one of the few stocks in financial services on this list with 51 consecutive years of dividend increases. And if we look at the past year, up about 15.44%. Now, what we can see on our dividend breakdown, the dividend yield sitting close to 0.7%, but the company doesn't use most of their capital to pay out dividends, but regardless, they still grow the dividend at a high rate, because look at this, 10-year free cash flow CAGR of 17.7%, 5-year, close to 13%. So this company is growing at a very high rate. There's a lot of potential for dividend growth down the road. At number 24 on the list, we have Stanley Black & Decker, stock ticker SWK, in the industrial sector with 51 consecutive years of dividend increases. And over the past year, they're actually down by about 6.12%, trading at $89.46. And if we look at the dividend metrics, the starting dividend yield is pretty high, sitting at 3.64%. And one of the things you'll notice is it's showing a negative payout ratio. When does this happen? Well, this typically happens if a company reports negative earnings, but we have to remember, at times there can be a big difference in earnings and free cash flow, and that's one of the reasons you really want to pay attention to both of these payout ratios, because we can see the free cash flow payout ratio was actually 56.6%. So that gives us a much better idea of how much capital the company's actually using to pay out dividends. Now, the dividend growth has been low, 5-year of 3.2 and 10-year closer to 5, and free cash flow growth has been slow as well, so this is clearly a more mature business, not growing at a very high rate. Coming in at number 26, we have Illinois Tool Works in the industrial sector with 50 consecutive years of dividend increases over the past year. It's traded relatively flat, down about 2.45%. And when we look at the dividend perspective, starting dividend yield is decent at about 2.3%, and the 10-year dividend growth has actually been really good at about 12.73%. So they've gone from $1.60 all the way up to about $5.42 in 2023, and now sitting at $6. So overall, dividend growth has been good, but free cash flow growth has been slowing, and as a result, the free cash flow payout ratio has been climbing higher and higher, which is not something you like to see. Next up, we have a utility stock, stock ticker ED, Consolidated Edison, with 50 consecutive years of dividend increases, and over the past year, they're only up about 2.73%. Now, when we look at the dividend metrics, it looks a little bit confusing. Yes, starting dividend yield, that's clear, 3.56%, but look at the free cash flow versus dividends paid out. Dividends paid out is essentially higher than free cash flow every single year, which is typically a massive red flag. Well, in the case of utility stocks, you typically want to pay more attention to the earnings payout ratio rather than the free cash flow payout ratio. And what we can see with the earnings payout ratio, sitting at 43.51%, so this dividend does look sustainable, but keep in mind, they don't grow it at a very high rate, looking at about 2 to 3%. Next up on the list, we have Automatic Data Processing, stock ticker ADP, an industrial stock with 49 consecutive years of dividend increases. In the past year has been really solid, up about 27%. And we can see the starting dividend yield sitting slightly above 2%. And look at the dividend growth, been really good over the past few years. 5-year dividend CAGR of 13.4 and 10-year 13.4. So dividend growth has been phenomenal. So we're looking at a nice combination of dividend growth along with dividend yield, and the company consistently uses about 50% of its free cash flow to pay out dividends. Next on the list, we have Archer Daniels Midland Company, stock ticker ADM, with 49 consecutive years of dividend increases. In the past year, they are down about 8%. And if we look at the dividend breakdown, starting dividend yield is pretty nice, above 3.8%, And the dividend growth has been really good as well at about 7.62% and 7.39% over the 5-year. And the free cash flow payout ratio looks decent at about 32.94%. And obviously, dividend growth has been pretty good over the past decade. Now, here's what you have to understand. Look at the free cash flow over the past decade. This is a very cyclical company, and that scares a lot of people off, and that's completely understandable, but you do have to keep in mind they've done a great job of continuing to pay out dividends despite their cyclicality. Coming in at number 30, we have another popular company you're probably familiar with, the Clorox Company, with 47 years of dividend increases, and over the past year, they're actually up by about 10%. And if you look at the dividend metrics, the starting dividend yield is sitting at about 3%. 10-year dividend CAGR at 5.3% and 5-year close to 4%, and it looks like as of last year they used about 62% of their free cash flow to pay out dividends, which is a little bit more than it has been historically speaking over the past decade. At number 31 on the list, we have Medtronic, stock ticker MDT, in the healthcare sector with 47 years of dividend increases, and if we look at them over the past year, they're up about 5.47% due to the recent run-up in their share price. And if we look at the dividend metrics, starting dividend yield is sitting at about 3%, but they're using a lot of their capital to pay out dividends. Free cash flow growth has slowed down, and even though dividend growth has been decent over a 10-year time period, we can see dividend growth is slowing down as well. Now, anytime you look at yearly dividends charted out, keep in mind, due to the timing of dividends, sometimes it might look like a hiccup, but just keep in mind, overall, they have been increasing dividends every single year. The next stock on our list has seen explosive dividend growth, and that is the Sherwin-Williams Company, with 46 consecutive years of dividend increases, and over the past decade, 260% total increase in their dividend payouts. And we can see in the past year, they're up about 19%. And if we look at the dividend breakdown, the starting dividend yield is low, sitting at 0.78%. They use very little of their capital to pay out dividends, but look at that 10-year dividend CAGR, 14.58%. The 5-year, 13.68%. And this dividend growth is backed by growing free cash flow, as we can see charted out right here. There's a lot to like about this company. SJM, the JM Smucker company, is in consumer defensive and has 46 consecutive years of dividend increases, but has been hammered over the past year, down close to 19%. And if we look at the dividend breakdown, the starting dividend yield is high, but a lot of that is because of the huge sell-off over the last year. They're yielding close to around 4%. But look at the free cash flows for this company. We're seeing quite a bit of volatility. It looks like it was decent from 2016 to 2021, but it's been reduced pretty dramatically over the last couple of years, pushing that free cash flow payout ratio higher. Now, we can see the free cash flow payout ratio still sitting just about at 60%, which isn't necessarily a dangerous level, but over time, that's going to continue to climb higher if free cash flow doesn't grow and the company continues to grow dividend, which eventually you can't grow dividends if free cash flow is not growing. At number 34 on the list, we have Franklin Resources in the financial services industry with 45 consecutive years of dividend increases, and they've been hammered over the last year, down about 25%, and because of that, they have a very high starting dividend yield, sitting at 6.16%. Now, when we look at the dividend history, it's interesting. It looks like there's a lot going on here, but we have to keep in mind this company has occasionally paid out special dividends. So for example, 2018, they had a lot of extra capital, so they did pay out a special dividend. Same back here. But overall, if we look at those dividend payments on a quarterly basis, yes, there are some special dividends, but those dividend payments do increase over time. Now, the huge concern is free cash flow is much lower over the last 5 years than the previous 5 years, which obviously not a good sign. There is some trouble on the horizon for this company. Next on the list, we have Brown-Forman Corporation coming in at 35 with 45 consecutive years of dividend increases, and this is another stock that is down huge over the last year, down over 40% now. And again, because of that, they have a higher than normal starting dividend yield compared to where their usual dividend yield is, coming in at 2.63%. And we can see this is another case of a company that has paid out some special dividends on occasion. But the free cash flow payout ratio as of right now is already pretty high, sitting at 82.7%, so it's unlikely you'd see a special dividend when they're already using that much capital to pay out dividends. But the 5-year dividend CAGR is sitting at about 5.5, and the 10-year sitting close to 6.4, but not a lot of free cash flow growth over the past 5 and 10 years. Coming in at 36, we have Aflac Incorporated, the financial stock with 43 consecutive years of dividend increases, and they've done pretty well over the past year, up close to 27%. And if we look at the dividend history, it's pretty clear dividend growth is a priority for this company. Starting dividend yield is decent at 2%. They don't use most of their capital to pay out dividends, which is pretty typical for an insurance stock, but the dividend growth has been really good. 10-year sitting at 12%, and the 5-year sitting at 16.5%. And while free cash flow growth has slowed down, free cash flow payout ratio is still very low, so they can continue to grow and pay out dividends. Coming in at 37, we have APD, Air Products and Chemicals, in the basic materials sector with 42 consecutive years of dividend increases, and over the past year, they're up over 28.5%, so a very good year for this company, and the starting dividend yield is sitting at 2.12% with a pretty nice history of growing those dividend payments, with a 5-year dividend CAGR at 8.8% and the 10-year at 9.5%. Coming in at number 38, we have Cintas Corporation, the industrial sector, with 42 consecutive years of dividend increases. And we can see over the past year, they're up about 32.5%. Now, when we look at the dividend breakdown, things look a little bit chaotic, but that's because they've changed the way they pay out dividends and the timing of it. If we actually scroll down and just look at the adjusted dividends over time, we can still see it is growing. Now, if we look at free cash flow growth for this company, it's been really good over the past 5 and 10 years, and the free cash flow payout ratios remain low, which means they have a lot of dividend growth potential moving forward. That's a good sign. At number 39, we have Atmos Energy Corporation, which is another utility stock with 41 consecutive years of dividend increases. And over the past year, they've actually done pretty well, up close to 25%. And if we look at the starting dividend yield, it's sitting at 2.3%. Now, like I mentioned earlier, we have to remember, specifically with utility stocks, looking at the free cash flow payout ratio typically doesn't make as much sense. For example, look, free cash flow is technically negative for nearly every single year over the past decade. We want to pay more attention to the earnings payout ratio, and we can see they've done a good job of growing those dividends with a 10-year dividend CAGR of 8% and a 5-year of close to 9%. At 40, we have T. Rowe Price, another financial stock with about 38 consecutive years of dividend increases, and over the past year, they've traded pretty flat, up close to 4%. And if you look at the dividend metrics, the starting dividend yield is really nice, sitting at about 4.28%. And if we look at the dividend history again, you're going to notice they paid out some special dividends over the past decade, but the 10-year dividend CAGR is really nice, 11%. The 5-year sitting close to 10%. So that's a good history of dividend growth combined with a pretty nice starting dividend yield. At 41, we have McCormick and Company Incorporated, a consumer defensive stock with 38 consecutive years of dividend increases. Over the past year, it's up about 12.4%, and if we look at the dividend metrics, starting dividend yield sitting at about 2.2%, with a 10-year dividend CAGR sitting pretty nice at 8.5%, and the 5-year sitting at about 8%. And the cash flow payout ratio looks pretty healthy overall, and this dividend growth chart looks very stable and very consistent, something I like to see. Next on the list, we have an energy stock. That's Chevron Corporation with 37 consecutive years of dividend increases, and over the past year, they're up about 5%. Now, this is actually pretty impressive for an energy stock because a lot of these times, these companies can't sustain their dividend payouts, and that's because oil prices can be so volatile. So pretty impressive. And we can see they have a starting dividend yield of about 4.16% and a 5-year dividend CAGR of 6.5%. That's a pretty nice combination. Again, I do want to be clear though, these stocks are volatile. Be careful when looking at energy/oil stocks. Next up on the list, we have Genuine Parts Company in the consumer cyclical industry with 33 consecutive years of dividend increases, and they're down about 17.5% over the last year. And if we look at them from a dividend perspective, the starting dividend yield is decent at about 3.4%, and we're looking at about 5 to 6% dividend growth when you look at it over different time periods. Now, when we look at free cash flow over the past decade, we see some fluctuations, but there's not a whole lot of growth. We can't see 2020 was a great year, obviously, but overall, we're not seeing a trend upwards. So the dividend is growing, but free cash flow isn't necessarily growing, and so we've seen a little bit of a spike up in the free cash flow payout ratio, especially since 2020. Next on our list, we have Ecolab in the basic materials sector with 33 years of consecutive dividend increases, and over the past year, they're up about 25.8%, and it's also worth noting that Bill Gates is actually a pretty large shareholder in this company. Now, if we look at them from a dividend perspective, the starting dividend yield is low at 1%, 10-year dividend CAGR pretty decent at 8.5%, and the 5-year sitting at about 7%, and they're not using most of their capital to pay out dividends, which is typically a good sign if you want to see dividend growth. And over the long term, we can see free cash flow has been growing, and it's grown at a rate over the past 10 years of a little above 6%. Coming in at 45, we have General Dynamics Corporation in the industrial sector with 33 years of dividend increases, and over the past year, it's down by about 3.2%. Now, the starting dividend yield sitting at 2.22%, and dividend growth is in upper single digits, close to about 9% over the past decade, and this is another company that doesn't use most of their free cash flow to pay out dividends, meaning they should be able to grow that dividend at a pretty decent rate moving forward. And also, look at this is a good sign. 5-year free cash flow CAGR at about 9%. At 46, we have West Pharmaceutical Services in the healthcare sector with 32 consecutive years of dividend increases, and they're down by 7.6% over the last year. Now, this one has a very low starting dividend yield, but they have been paying it out for a long time, and the dividend has been growing. We can also see they don't use very much of their capital to pay out dividends, and that's an understatement. Only 13% of their free cash flow goes to pay out dividends. So the free cash flow growth from this company actually looks phenomenal over the past decade. Look at how much it's grown. The 10-year sitting at 20.41%. So as a result, if we look at the past 10 years, this company has way outperformed the market. Next up, we have Roper Technologies in the industrial sector with 32 consecutive years of dividend increases. And over the past year, they're somewhat flat, but have seen a spike up over the last month and are up about 2.3%. Now, this is another one where the starting dividend yield is very low, but the free cash flow growth actually looks pretty decent over the past decade. Now, there was a little bit of a drop here in 2022, as we can see, but overall free cash flow is growing, and as a result, dividends have grown at a very high rate, and they use very little of their capital to pay out dividends, only a 15% free cash flow CAGR. So this dividend history looks really good. Coming in at 48, we have ExxonMobil, the energy stock, with 32 years of dividend increases, and over the past year, they're up by about 4%, and if we look at the dividend metrics, they pay a decent dividend, coming in at about 3.52%, and the 10-year dividend CAGR is relatively low at 3.58% in the 5-year, just 2.28%. And again, I do have to mention, anytime you have a dividend stock that's growing its dividend at a rate below the rate of inflation, they're technically paying out less in dividends every single year. So something to keep in mind. Now, the other point we have to make is this is an energy/oil stock, so there will be volatility due to the price of oil fluctuating so much. Now we come to another industrial stock, and that is Caterpillar with 31 consecutive years of dividend increases, and they've been on a really good run over the last few years. Over the last year, up 23%, but if we zoom out a little bit more, they're all the way up from about $164 per share. Now, if we jump over to the dividend metric, starting dividend yield is sitting close to 1.5%. They use around 25% of their capital to pay out dividends, and the 5-year dividend CAGR close to 8%, and the same is true with the 10-year dividend CAGR. And what we can see is free cash flow has grown quite a bit over the last 5 years. Coming in at number 50, we have Church & Dwight Company in the consumer defensive sector with 31 consecutive years of dividend increases. And over the past year, this stock is up by about 6.27%. And if we look at the dividend metrics, the yield is low, sitting at about 1%, with a 10-year dividend CAGR of 6.23% and 10-year free cash flow CAGR of 6.44%, but a free cash flow payout ratio of only 33%, and it's remained below 40% for the duration of the past decade, which is something I definitely love to see. So it means free cash flow growth is sustaining that dividend growth. Next up, we have C.H. Robinson Worldwide in the industrial sector at 31 consecutive years of dividend increases, and over the past year, they're up by 16.6%. Now, if we look at the dividend metrics, starting dividend yield is decent, close to 2.5%, but dividend growth has really been slow, especially over the past decade at just about 3.29%, and free cash flow has been relatively choppy. As we can see, 2022 was a great year, but pretty stark decline from 2022 to 2023, and over the past 5 years, free cash flow really hasn't gone anywhere. Next up, we have Brown & Brown in the financial services sector with 31 consecutive years of dividend increases, and over the past year, they've done very, very well, up nearly 37% now. So obviously the starting dividend yield is going to be a little bit lower because they've gone up so much in share price over the past year, but starting yield sitting at 0.5%, with double-digit dividend growth, and free cash flow growth has been really good as well, pretty much above 10% over the past 10 years and 5 years at about 12.33%. So it's clear this company is growing, and we also know this because the free cash flow payout ratio was so low, sitting at 14.35%, so they're using most of their capital to reinvest back into the business, so I think we'll continue to see a trend of high levels of dividend growth. Now we have McDonald's Corporation, consumer cyclical with 31 consecutive years of dividend increases, and if we look at McDonald's over the past year, it's pretty flat, down by about 1.5%, but if we look at the dividend breakdown, starting dividend yield sitting at 2.33%, and it looks like a pretty straightforward history of around 7.5% dividend growth over the past 5 and 10 years. Now, historically speaking, they've paid out around 50 to 75% of their free cash flow in dividends, and as of last year, is sitting at about 62.5%. At 54, we have LIN in the basic materials sector with 31 consecutive years of dividend increases, and over the past year, they're up about 8.56%, and if we look at the dividend metrics, the starting dividend yield sitting at about 1.25%, but the good news is free cash flow has grown quite a bit, especially just in the last 4 to 5 years. Look at that 5-year free cash flow CAGR, almost 25%. The 10-year, 19.92%. So 5-year dividend growth is about 10%, but look at the free cash flow payout ratio over time. At the beginning of the past 10 years, they were using around 70 to 80% of their free cash flow to pay out dividends. Now it's only around 40%. That's phenomenal news for the company. Next up, we have another stock in the financial services sector, and that's Chubb Limited, a stock Warren Buffett actually recently added to his portfolio, and it has about 31 years of dividend increases. And if we look at this stock over the past year here on Seeking Alpha, what we can see is they're up by about 13%. Now, if we look at the dividend for this company, yield is sitting at about 1.31%, And dividend growth isn't a great way to look at this in a situation on a yearly basis because the timing of the payouts is actually fluctuated. But if we come down here and actually look at them on a quarterly basis, it's clear. The trend is upward. We can also see free cash flows continue to grow and they're using very little of their capital to pay out dividends. At 56, we come to Expeditors International of Washington. This is an industrial stock with 30 years of dividend increases. And if we look at them the past year, they're actually down by about 11.5%. But if we look at the dividend metrics, the dividend growth is clearly pretty good, starting dividend yield a little bit on the low side at about 1.28% and a 10-year dividend CAGR of 8.6%. But here's the good news. Look at the 5-year free cash flow CAGR, 14%, the 10-year, 11%. So all in all, free cash flow is growing for this company at a very healthy rate. It's down a little bit from 2022, but overall, we're seeing a trend in the right direction, and they're using most of their capital to reinvest back into the business. At 57, we have stock ticker ALB in the basic materials sector with 30 consecutive years of dividend increases. And this is another stock that is down a lot over the past year. And I do want to point out at the time of this recording, short interest is very high. So there's a lot of people currently betting against this stock, which is definitely something to note. Now, the starting dividend yield is sitting at 1.88%. And the 5-year dividend CAGR is pretty pitiful, sitting at 1.84%, and the 10-year sitting at 3.88%. And we can even see in 2023, they actually reported negative free cash flow, which for a stock like this is not sustainable over the long term. And it means the dividend is not sustainable unless something changes. So it's important you make note of that. Next up, we actually have a real estate investment trust, and that's Essex Property Trust, stock ticker ESS, with 30 years of dividend increases. And over the past year, they're up almost 20%. Pretty impressive for a REIT. And remember, when we look at dividend metrics for a REIT, a lot of this doesn't necessarily apply to REITs. We can see starting dividend yield sitting at about 3.5%, and the dividend growth has actually been really good for a REIT. But when it comes to dividend sustainability, we don't pay attention to the earnings payout ratio or even the free cash flow payout ratio. Instead, we want to look for adjusted funds from operation payout ratio. That's the true measure of the safety of the dividend for a REIT. And we can see in their case sitting at 71.9%, which is healthy for a REIT. So this REIT seems to be performing pretty well. Next up, we have A.O. Smith Corporation, stock ticker AOS, operating in the industrial sector with 30 consecutive years of dividend growth. And over the past year, they've actually drawn back quite a bit, down about 15.57%. But if we look at the dividend metrics, starting dividend yield close to 1.5%, but the dividend growth has been pretty high over the past decade. You can see here, 10-year dividend CAGR of 12.57%, and they're not even using most of their capital to pay out dividends, only a 30% free cash flow payout ratio. Next up, we have a stock that's on here pretty much by technicality. It wasn't technically a spinoff, it was more of a merger, but we have Amcor in the consumer cyclical sector with 30 consecutive years of dividend increases. And if we look at the past year, they're up about 2%. Now, if we look at the dividend metrics, it's a little bit choppy because, again, they did go through a merger. Next up, we have one of the few technology stocks on this list, and that's IBM International Business Machines Corporation with 29 consecutive years of dividend increases, and they've had a great year. If we look at this, they're up about 37%. And if we look at the dividend metrics, the starting dividend yield is sitting at about 2.58%. Free cash flow payout ratio close to 50%, so they use about half of their free cash flow to pay out the dividend. But the dividend growth has been really slow over the past 5 years, below the rate of inflation. At number 62 on the list, we have Cardinal Health in the healthcare sector with 28 consecutive years of dividend increases. And over the past year, they're up almost 20%, so it's been a good year. Now, from a dividend perspective, the starting dividend yield is sitting at about 1.57%, and while the 10-year looks decent at 4.25%, the 5-year dividend CAGR is very low, sitting at just 1%, and it makes sense why. Look at the 5-year free cash flow CAGR. It's gone pretty much nowhere. So while over the past decade, free cash flow has grown, the past 5 years, it really hasn't. So we can see dividend growth correlates to free cash flow growth. It's important to keep in mind. Now, with that being said, they are only using about 22% of their free cash flow to pay out dividends, which is a good sign, but over the long term, you have to grow free cash flow to grow dividend payments. Next up, we have another REIT, and this is actually one of the most popular real estate investment trusts out there, and that's Realty Income with 27 years of dividend increases. And we can see over the past year, it's traded pretty flat, currently down about 1.56%. Now, again, we're talking about a REIT, so we don't look at typical dividend metrics. We can see dividend yield sitting at 5.77%. But if we look at the dividend growth history for this REIT, we can see a couple of things. One, they actually pay out dividends on a monthly basis, and they grow that dividend. So when it comes to sustainability, let's look at that AFFO payout ratio. And again, forward looking, we can see it's sitting at 75%. So Realty Income pays big dividends. They tend to grow it at about 2 to 3%, and the dividend looks healthy. At 64 on the list, we have Fastenal Company in the industrial sector with 26 years of dividend increases. And over the past year, it's up by about 8.5%, and we can see the starting dividend yield sitting at 2.08%, And this company does use the majority of their capital to pay out dividends. But here's what's impressive. Despite this, they've still grown free cash flow at a really high rate over the past 5 and 10 years. And as a result, they've been able to grow their dividends at a high rate. And even in 2020, they're actually able to pay out a special dividend. And then we come to Lowe's company, which I'll admit I meant to have this at the top of the list. I missed this one earlier, but it has 61 consecutive years of dividend increases in the consumer cyclical sector. And if we look at them in the last year, they're up by about 23%. And the dividend metrics look absolutely phenomenal. The starting dividend yield is 1.72%, but look at the dividend growth over the past 5 and 10 years, 17% and nearly 19%. That is phenomenal dividend growth. And the free cash flow CAGRs don't look as high as they really should be, and that's because free cash flow has gone a little bit lower over the past few years, but they're still trending in the right direction. And then as a bonus, we have Altria Group, stock ticker MO, listed right here. And this is another one where there is some debate as to whether or not they technically qualify as a dividend aristocrat. But if you give them the technicality, they have 55 years of dividend increases. And if we look at Seeking Alpha, what we can see is over the past year, they're up by about 27.4%. And this is actually a big dividend payer. The starting dividend yield is 7.76%. And what's impressive is along with that big dividend yield, not only have they grown the dividend, they've grown it at a pretty decent rate with a 5-year dividend CAGR of 4% and a 10-year at about 7%. And they're also growing free cash flow, and management has stated that they intend to pay out 80% of the company's earnings in the form of dividends. So there you go. There is every single dividend aristocrat as of the start of 2025. Now, it's important to keep in mind, some are debated as to whether or not they are technically dividend aristocrats. But with that being said, you can get this spreadsheet for free at the link in the description. And if you want to take things a step further, you can actually update the data in this spreadsheet automatically simply by getting the ticker data add-on in Google Sheets. Ticker data is what allows me to automatically import stock financials straight into my spreadsheet, as well as create incredibly powerful spreadsheets that'll automatically update. So go ahead and let me know what you think in the comments down below. And like always, please don't forget to like and subscribe to the channel.